Imagine waking up one morning, checking your bank balance and realizing that the money you thought was safely yours is suddenly frozen, converted, or partially gone, not because you broke the law, not because the bank was robbed, but because the rules quietly changed when no one was paying attention. This is not a conspiracy theory, it is not science fiction, and it is not something reserved for failed states. It is the reality of bail-in laws, and understanding how they work could completely change how you think about money, savings, and financial security. To grasp why bail-ins exist at all, we need to rewind to the global financial crisis of 2008. Back then, banks around the world took massive risks using leverage, derivatives, and complex financial products that most people never understood. When those bets went wrong, the system teetered on collapse. Governments stepped in with bailouts, using taxpayer money to rescue banks deemed too big to fail. In the United States alone, trillions of dollars in guarantees, loans, and emergency programs were deployed. While this stabilized the system, it created a political and moral backlash. Ordinary citizens asked a simple question: why should taxpayers pay for the mistakes of private financial institutions? Out of that anger came a new framework. Instead of bailouts, where public money saves banks, regulators designed bail-ins, where the bank saves itself by using internal resources. On paper, this sounds reasonable. Shareholders take losses first, then bondholders, and, if necessary, large depositors. The key detail that shocks most people is that in many countries, deposits above a certain insured threshold are legally considered unsecured loans to the bank. When you deposit money, you are not placing it in a vault with your name on it. You are lending it to the bank, and the bank owes you an IOU. This is where deposit insurance comes in. In the United States, the FDIC insures deposits up to $250,000 per depositor, per bank, per account category. In the European Union, the standard coverage is 100,000 euros. This insurance is meant to protect everyday savers from losing everything if a bank fails. But anything above that limit is exposed. Under bail-in laws, those uninsured deposits can be converted into bank equity, written down, or frozen to recapitalize the institution. This is not theoretical, it has already happened. In 2013, Cyprus became the first real-world test case. As part of an international bailout agreement, the country implemented a bail-in on its largest banks. Depositors with balances above the insured limit saw significant portions of their money seized and converted into bank shares. Some lost over 40%. People woke up to find their accounts locked, withdrawals restricted, and trust shattered. The lesson was clear. When bail-in laws are triggered, access to your money is no longer guaranteed. Since then, similar legal frameworks have been adopted across the developed world. The European Union's Bank Recovery and Resolution Directive explicitly outlines bail-in mechanisms. Canada has a bail-in regime for certain bank liabilities. The United Kingdom has its own resolution framework. Even in the United States, while the structure differs, regulators have the authority to impose losses on creditors, and large depositors fall into that category. The language is technical, buried in regulatory documents, but the implications are simple. In a systemic crisis, your bank balance is not untouchable. Now, before panic sets in, it is important to be precise. Bail-ins are designed as a last resort. Regulators prefer to avoid them because of the damage to confidence. Banks are also required to hold capital buffers and undergo stress tests to reduce the likelihood of failure. But here is the uncomfortable truth. These safeguards assume normal crises, not extreme ones. They assume that problems are isolated, not systemic. History shows that when crises spread, rules bend quickly. Think about how banks actually operate. They do not keep most of your money in cash. They lend it out, invest it, and use it to support a vast web of financial activity. This is fractional reserve banking. It works as long as confidence holds. The moment confidence cracks, liquidity vanishes. Bail-ins are a way for regulators to stabilize banks without immediately resorting to printing money or raising taxes. From a policy perspective, they are a pressure valve. From a depositor's perspective, they are a risk most people never priced in. This brings us to a crucial psychological shift. For decades, people were taught that bank deposits are the safest place for money. Cash under the mattress was risky. Precious metals were old-fashioned. Diversification meant stocks and bonds, not questioning the banking system itself. Bail-in laws quietly reversed that hierarchy. They introduced counterparty risk into what people assumed was risk-free. Your safety now depends on the solvency of your bank and the decisions of regulators during a crisis. Another layer to this issue is inflation and monetary policy. Since 2008, central banks have dramatically expanded their balance sheets. money supply has grown at historic rates, especially after 2020. While this helped stabilize markets, it also eroded purchasing power. Savers were hit from two sides. Low interest rates meant bank deposits earned almost nothing, while inflation quietly reduced real value. In that environment, the idea that deposits could also be subject to bail-ins adds a third pressure point. Let's put this into a simple analogy. Imagine storing grain in a community silo. You believe your grain is safe because the silo has GUAR, DS, and insurance. But in reality, the grain is constantly being loaned out, traded, and used by others. If there is a famine, the community may decide that everyone with excess grain must contribute to keep the system running. You still technically own grain, but access and quantity are no longer fully under your control. That is how bail-ins function in modern finance. This is why high net worth individuals, corporations, and even governments manage cash very differently than ordinary savers. They spread deposits across multiple institutions, use short-term government securities, or hold assets outside the traditional banking system. They understand that banks are not vaults, they are counterparties. The average person is rarely told this in clear language. Precious metals enter this discussion not as a prediction of doom, but as a contrast. Physical gold and silver have no counterparty risk. If you hold them directly, they are not someone else's liability. Historically, during banking crises, capital controls, and currency resets, precious metals have preserved purchasing power when paper claims failed. This is not about prices going up tomorrow. It is about optionality. It is about having assets that operate outside the bail-in framework entirely. None of this means banks are about to seize everyone's accounts tomorrow. That kind of fear-based thinking is unhelpful. What it does mean is that the financial system has changed in ways most people have not fully processed. The rules of the game are different from what they were 20 years ago. Understanding bail-ins is not about panic. It is about awareness and preparation. So the real question becomes this: if bail-in laws exist, if deposits are legally unsecured above certain limits, and if systemic crises have a habit of breaking assumptions, how should individuals think about protecting their savings in a world where trust in institutions is no longer absolute because